Hello, welcome to my mortgage market update. So one of the big questions out there is one of the most frequently searched Google terms as it relates to housing right now is the housing bubble about to burst? Are we in a housing bubble? Is the housing market going to crash? So that is a very popular search on Google, and there's a lot of misunderstanding as to how this market is different than the last meltdown. The meltdown is what people remember, and they are concerned that they're seeing kind of the same things, like very fast appreciation, and that now that the interest rates are rising and gas is going up, and there's a lot of like all those things in the economy that are happening, people are concerned that we are going to have a housing bubble. It's going to burst, and the housing market will crash. So let's talk about a couple of things that are different from the last time and now, when there was like skyrocketing appreciation. So it was completely different last time. First of all, that housing market took us into a recession because of the risky lending that was happening. Investors stopped investing in those types of mortgages. Houses then, to sum it up rather quickly and with very little detail, the houses were declining in value. We're talking about decline of like 20% in a short amount of time. There was actually like a ton of inventory then that came onto the market because people didn't invest much in their homes and to get their homes. So it was just so much easier to walk away from them at that time. So now we are in a totally different type of housing market where we've been really responsible with lending, great people having great credit with a ton of cash invested into the acquisition of their home, the purchase of their home. And we are coming off a year of 19% appreciation, which is a ton of appreciation. That means if my house was worth $400,000 12 months ago, it would be worth $480,000 12 months later. That's 19% appreciation in 1 year, roughly. It's actually 20, but you get the point. And then back then, because people were walking away from their houses, there was a lot of foreclosures, and that was putting like excess supply onto the market. So values dropped, depreciation actually happened where houses were worth a certain amount and then the value was lower than that. They were depreciating. Now, right now is totally different. We are coming off of a year where we had 20% appreciation that would be expected to normalize probably to about 5% appreciation if we average together all the projections. 5% appreciation is still good. Again, if that means if my house is worth $400,000 now, by 12 months from now, it's going to be worth $420,000. So that's still strong appreciation over the course of just 12 months. Then there's the whole supply and demand thing that we are experiencing. Back then, there were 3 million, during the time of the mortgage meltdown, there were 3 million more homes on the market than there are now. And there were a lot less households that needed homes. So there's 14 million more households now and 3 million less homes for sale. So it's just a matter of simple economic supply and demand. We do not have enough homes on the market for the amount of buyers that are in the market to buy. So there's that. And we are seeing indicators of a recession. There is probably a recession looming. Recessions, as they pertain to housing markets, though, is not a bad thing for my industry, the housing industry. Typically, housing and interest rates do very well in a recession. So we would expect to see that rates would go down and that housing should stay solid as far as values. Mortgage rates are up due to inflation, and there's no doubt about it that there are less qualified buyers in the marketplace, but we actually had an excess of qualified buyers anyway. So as far as that affecting the value of homes, it is not going to cause depreciation in any way. We just as recently as this weekend, in trying to help people make offers and things, we're still seeing multiple offers within a day of listing a home. So we are still, that's still happening in the market. It's still strong. We do have a busy news week this week, so things that we look at in the mortgage business at these types of things will relate to rates. So as we go, you'll hear more and more about these with each update. But we have the CPI report this week, which is the Consumer Price Index, which measures inflation. We have the Producer Price Index report, and we have the 10-year auction. And we're watching the 10-year Treasury very closely. It's up as high as it's been in the past 3 years. So that is affecting the interest rates. Interest rates are as high as they've been in the past 3 years. So that's what's happening right now. If you ever have any questions or want to talk about things as they specifically pertain to maybe your own situation, I'd be glad to talk with you. And join me next time for my next update, which will certainly be real soon. Have a great one.